Welcome to our webinar on Social Security taxation post Big Beautiful Bill. For those that don't know me, I'm Victoria Larson, owner of Vitality Investments. Here with me today is Caprice Teresi, our Director of Operations, and our guest speaker is Hamilton Morales, Senior Vice President at Financial Independence Group. Just a quick side note on Financial Independence Group, who they are. They are one of our business partners that helps us with product solutions on the insurance side. So they help us with long-term care, life insurance, annuities, as well as disability. They also provide us with professional resources on specific topics, and one of those happens to be Social Security, and that is Hamilton Morales's area of expertise. He knows everything about Social Security and the history about it. So our view is that the Big Beautiful Bill was 900 pages, and we thought we'd see some value in education on this very topic here today. So a few housekeeping items. We have muted all of you. If you have questions, we encourage you to put those in the chat box. Caprice will be fielding those questions as they come up and either relay them to Hamilton or myself. We expect this meeting to be about 30 minutes, could be a little bit longer based on questions. And lastly, we've got our disclosures here that we have to share with all of you. All right, so Hamilton, before we jump in, the 900-page bill, big changes here. Probably the best thing that happened on that is the tax cuts of 2017 that were expected to sunset December 31, 2025 have been extended. That being said, folks are really confused about what's going on in Social Security and taxation. So I hand it over to you. Is Social Security still taxed?
Wow, that's a great question. So we heard, for so long that the bill was going to get rid of Social Security taxation. And when it left the House to go to the Senate, that was in there, that there was not going to be any taxes on Social Security benefits. Unfortunately, the Senate changed that. And instead of getting rid of the taxes on Social Security benefits, what they did was they increased the standard deduction. And we're going to actually talk about that here in a little bit. But by doing that, what they're telling us, I have no idea how they're getting these numbers, but what they're telling us is that upwards of 88% of all people on Social Security will not pay taxes on their benefits. So what does that look like? Not real sure, but we definitely are going to go through what changes have happened, what the current taxation, how that works, how they do the calculation. We're actually going to go through a couple scenarios on that, and then hopefully be able to get into some solutions, some things that we could talk about that might help the folks that still have to deal with taxation on Social Security. Maybe there's some things that they can do now to get ready for that time. So let's kind of get into it.
Good.
So how does the IRS determine whether your Social Security benefits will be taxed or not? Well, what they're going to do is they're going to look at what's called provisional income, not taxable income, even though that's part of it, but it's called provisional income. And it's just the income that the IRS looks at to determine whether you go over certain thresholds, to determine also how much of your Social Security benefits will be taxed. You can see up on your screen now, 50% of your Social Security benefits goes in the pot. Any ordinary income, so wages, any dividends and capital gains, any non-taxable interest also go in. So let's break that down a little bit. It makes it a little bit easier when we look at this slide. So it breaks it down even more. So what they're going to do is they're going to look at if you're still working. Now remember, this is assuming you're taking your benefits, okay? If you're not taking your benefits, you don't have to worry about it. But if you're taking your benefits, they're going to look at any earned income you have coming in, any distributions from retirement accounts. So that's going to be your IRAs, your 401ks, your 403bs, etc. Then they're also going to look at any interest from interest-bearing accounts like CDs. And this also includes capital gains. They're also going to look at pensions, rental income, interest off of municipal bonds. So I know municipal bonds are supposed to be income tax free, and they are, but as it relates to provisional income to determine whether you have to pay taxes on your Social Security or not, they're going to take that interest, they're going to add that to the pot. And then they're going to take 50% of your Social Security benefits and add that. So they add them all together, depending on what fits your particular situation. And if you go over certain thresholds, anywhere up to 50 or maybe even up to 85% of your Social Security benefits will be taxable based off of whatever tax bracket that you're at. So let's dive in a little bit deeper here. Whoops. Did I just do that twice? I did. All right. So let's look at what those thresholds are. So this is very important. Everybody needs to understand. This is what was supposed to change. They were supposed to get rid of this, but it didn't happen. It's still the same. So if you are single and your provisional income, so the slide before, all those provisional incomes, if your provisional income is between $25,000 and $34,000, then up to 50% of your Social Security benefits will be taxable. If your provisional income is over $34,000, then up to 85% of your Social Security benefits will be taxable. Now, if you're a married couple and you're over $32,000 in provisional income, up to 50% is taxable. And then if you're over $44,000 in provisional income, up to 85% of your Social Security benefits will be taxable. Now, if you're like me and you're looking at this, you're going, certainly those can't be the numbers. And the answer to that question is, well, yeah, actually they are. Those are the same numbers as when they first put this into law. First one was back in 82, and then again in, I believe it was 96, 95, 96 timeframe. The second portion. The problem is they never added inflation to this, no inflation adjustment. So these are the numbers as they are today. And so the vast majority of people that are on Social Security hit these, at least one of these thresholds, if not the highest of these thresholds. All right, so what did change with the bill? Well, remember, I told you that they didn't change taxation on Social Security benefits. What they actually did was they increased the standard deduction. So if you look on the left side of your screen, what you're going to see is before the bill was signed, the standard deduction for a single filer was $15,000. Married filing jointly, you got a $30,000 deduction. Of course, then you had head of household was $22,000. If you were 65 and older and single, you got an additional $2,000 deduction, standard deduction. And if you were married, then you got $1,600 each, so $3,200 standard deduction on top of the 30. So that was before the bill was signed. What changed? Well, after the bill signed, what they did was they increased the standard deduction for single filers to $15,750, for married filing jointly to $31,500. Head of household only went up $500 more. The 65 plus additional deduction did not change at all. They did add what I call this bonus deduction for those that are 65 and older. And right now it's only going to be for 4 years. So 2025, 26, 27, and 28. That's it. And what it says is that depending on your income, and we'll dive into that a little bit more in just a minute, but depending on your income, if you're under the income thresholds and you're single, you can get an additional $6,000 deduction, or if you're married, $12,000 deduction. Now, if we look at that holistically, before the bill, single filers only got $15,000. If you were single and 65 or older, it was $17,000. If you're married filing jointly, it was $30,000. If you're married filing jointly and you're over 65, it was $33,200. Now look at what the bill did. Single filers, $15,750, didn't change very much. Single filers, 65 plus, you went from 17,000 to 23,750 in deductions. It's pretty big. Married filing jointly, you went from 30,000 to 3,150. But if you were married filing jointly and over 65 or over, then you're talking 46,700 in standard deductions. Now, is that going to help you with Social Security benefits? Maybe. It depends on the situation. And again, we're going to talk about that here in just a minute as we go through some different scenarios out there. So remember I said that last tier, that bonus deduction, kind of comes with a caveat, honestly. So if you're an individual filer, so if you're a single individual filer, you get the full 6,000 additional deduction as long as you are $75,000 and below. And that's modified adjusted gross income. If you're between 75,000 and 175,000, depending on where you're at in that area, that deduction is going to gradually go away. It's going to phase out. If you're over 175,000 and your modified adjusted gross income, that 6,000 is gone. Now, for joint filers, works the same way. Obviously, higher numbers up to 150,000, you get the full 12,000 if you're married filing jointly. If you're between 150,000 and 250,000, it's going to start to phase out depending on where you're at in that spectrum. If you're over 250,000, no deduction.
Hamilton, can I ask you a question here?
Absolutely.
On that joint filer, if I'm 65 but my spouse is not 65.
I knew you were going to ask that.
Yeah.
And I forgot to look that one up.
Yeah.
So that's a great question.
Yeah, I happen to kind of know that. So it is.
Oh, great.
You have to be 65. Both of you have to be 65 to qualify for that. So if one of you are 65, you're only getting $6,000 deduction. Both of you have to be 65. That's one of the conditions of that senior bonus.
And that's not a shocker, right? So they're going to put any type of caveats they can put on that, they're going to do it. And so that's not surprising to me that they did that. So if you're both born in the same year, life's good. As soon as you both turn 65, you get that deduction. But if you are 65 and your spouse is, let's say, 62 or 60, which we do see a lot of, then only one of you gets that deduction moving forward, assuming you're under the income modified adjusted gross income threshold, which is key.
Right. There's a couple other questions that just came over, and I don't think Caprice is able to see these. So are Roth IRA dividends and capital gains included in the calculation of provisional income?
Capital gains is any type of Roth distributions are not. They are 100% income tax free and provisional tax free. Yep. Right. And we're actually going to talk a little bit about that a little bit later on.
Perfect.
Yep, absolutely. Great question, though. Very good question. All right. So if you want to get into the nuts and bolts of how the phase out works, you can see it right here in front of you. So if you're an individual and your modified adjusted gross income is over 75,000, then the deduction is reduced by 6% for every dollar over that amount. And then for joint filers, it's over 150,000. So if you want to get the little calculator out for those that love to do the math, then you can figure out exactly what you're looking at. But remember, this is based off of your modified adjusted gross income, not your gross income. Okay.
Got it.
All right. So let's look at a couple of examples here. And this is quite interesting. When I pulled this up, this really floored me from the standpoint of, because one of the questions I get all the time is, when is the best time to take Social Security? And I've always looked at it from a standpoint, especially if we're talking about a married couple, that the one who has the higher of the two benefits should always wait till age 70 if they can, if it makes sense for them, because that benefit's going to last for both lifetimes. For the person that is deferring, and if they predecease their spouse, then their spouse gets to step up to that higher benefit. And so we always want to make sure that the surviving spouse gets the highest possible benefit. What I didn't know is that there's more to the story than that, and we're going to look at it and you'll see what I'm talking about here. So on your screen, you got two different scenarios. So scenario one, we've got $45,000 in Social Security benefits, and we've got $55,000 in IRA withdrawals. Now, this could be just your own withdrawals, you're just taking money out for income, or it could be required minimum distributions or a combination. Doesn't make any difference. They're withdrawals from your retirement accounts that are what's called tax deferred. Okay, so 100% of that money is going to be taxable when you pull it out. So the total provisional income is going to be $77,500. Okay, so that's half of the Social Security, which is $22,750, plus the $55,000 IRA withdrawals. That gives us $77,500. Now, what they're doing here is they're looking at different taxation here. So you take the 77,000 minus the 44,000. So the 44,000 is standard deduction, right? Gives us 33,500. So that equals at 35%, 11,725. So the total taxable benefit is 34,475. Taxable benefit being Social Security. Okay. So when you look at that, is that 85%? No. Is it 50%? No. It's 77%. So if you go back and you look at the slide that I did a few slides ago, where it gave you up to 50% or up to 85%, that's not a static number. Those aren't static numbers. They're going to do a calculation to see, based off of standard deduction, based off of different calculations, exactly what's going to actually be taxable for your Social Security. The maximum it can be is 85%, but it could be less than that. And as you can see, it's 77% here. Well, if we go to the one below, you'll see that there's 75,000 in Social Security benefits. So what does that tell you? I mean, 75, that's a lot of money for Social Security benefits. So that tells you that this person or this couple as a whole waited. They deferred till age 70 to turn on their benefits. So they got a higher benefit. Then they took $25,000 out of their IRA for withdrawals. Again, could be RMDs, could be just free withdrawals, whatever the case may be, it's taxable. So their total provisional income is $62,500. So that's half of their Social Security benefits. And the $25,000 in IRA withdrawals. So they do the same calculation below and look at the total taxable Social Security.
Yeah, significant.
It's only 29%. That's mind-blowing when you start thinking about that. I'm not a CPA, so I don't dabble in these numbers, right? So when I looked at this, I had no idea that it was that different when you look at these. And so the biggest piece of the bottom one is that they had a higher Social Security benefit. So when you look at that from a provisional standpoint, yeah, you're going to be over the 44,000 as a married couple, which should be 85%. But when they do the calculation, it's not the case. And so let's get into some specifics here of how this works. So you've got both scenarios right there. So let's look at the one on the left first, the 45,000 in Social Security benefits, 55,000 in IRA. So taxable Social Security in that particular one is 34,475. The taxable IRA income is 55,000. So the total taxable income is going to be 89,475. But remember, we have a standard deduction. Now, this one is somebody who is 65 or older. So understand that. So we take the $31,500. This is a married couple. We also deduct an additional $15,200. That's the $3,200 from the 65 plus, and then the bonus $12,000 amount. Okay. So the net taxable income is $42,775. So for the federal income is going to be $4,656. Look over to the right. $75,000 in Social Security benefits, $25,000 in IRA distributions. Taxable Social Security benefits, remember, it was only 29% based off the calculation. That's $21,725 that's going to be taxable. IRA income, $25,000. So the total is $46,725. We deduct the standard deductions and the plus 65. Net taxable income, $25. That's huge. It's a huge difference. Now, there's a couple things to take away from this. What if I can't wait till age 70? Is there anything I can do? And the answer is, well, yes. There are some things that you can do. I mean, we're going to talk about those here in just a minute. But it's more to this than just trying to decide, oh, am I going to turn it on at 62? Am I going to turn it on at 65? Am I going to turn it on at 70? What about my wife? What about my husband? There's more to it than that. And I think you can see just a touch of that with these slides that we've been going through, because quite honestly, it depends on the individual, where the income is coming from. There's just so much more to that. So with that being said, I'm going to give this back over to Victoria, because I believe there are some things that people can do if they're willing to be proactive and really take advantage of these standard deductions, especially if they're over 65.
Hamilton, I'm certainly going to cover that, but we have one other question that came up. Do you have to be collecting Social Security to receive that $6,000 senior bonus deduction?
No. That's another great question. So I know we're talking Social Security benefits here, but that standard deduction is for, so the $31,500 if you're married, or if you're not, $15,750. That's for everybody. And then you've got the one below that, which is the oh shoot, my brain just went dead. 1,600 and the 2,000 and the 1,600. That's if you're 65 plus. You don't have to be turning on your Social Security to get that. That's just a normal standard deduction for those 65 and over. And then the bonus deduction for 65 and over, same thing. You don't have to have your Social Security on, and you can still get that deduction as long as your modified adjusted gross income is below the threshold. And this is a big deal. And that's a great question and a great segue to Victoria, because if you don't turn on your Social Security benefits and you're 65 and older, Victoria, what can they do with those standard deductions?
They can do Roth conversions with those standard deductions. And that's where we're going to go. Like? Yeah. So folks, here's a little part on that big, beautiful bill. That big, beautiful bill is in law right now that it's supposed to last in perpetuity forever, right? Well, a couple of things we need to know. First of all, it was passed under, and I just lost it, the oh my goodness, budget reconciliation. Budget reconciliation process. By the way, that has a budget window of 10 years. So if these cuts, these new big, beautiful bill tax cuts are going to increase the debt past 10 years, this will not work. So plan on having these deductions for about 8 to 10 years. Now, the catch is that senior bonus deduction is very sweet. For couples, that could potentially be $12,000. However, if we're doing a $100,000 conversion, we've now phased out of that. So if we go to that next slide, this is where tax planning becomes really important here, because we have to decide what makes the most sense. There are different trade-offs here. If you've got a lot of money in that tax deferred account, the fact that we got this gift of the 22, 24% tax bracket still in existence, then we might forego that senior bonus deduction and optimize the ability to do Roth conversions at historically low rates. Depending on your situation, though, maybe you can take advantage of the senior bonus deduction and use it as a way of converting $12,000 more and not paying any more tax. Or it could be a strategy where you're 63 right now, 63, 64, we want to take more and do larger deductions so that you could take advantage of that senior bonus deduction the next couple of years. Bottom line is there's many different strategies here. The Big Beautiful Bill gave us a longer runway for doing Roth conversions while they're still on sale. And now we've got this other senior bonus deduction that we have to decide, does it make sense or to leverage that or not? And that may mean delaying that Social Security. So with that, I'll open it up to any additional questions folks might have here.
I know that was fast.
I know, I covered it quickly. It becomes if more and more important to do tax planning and
Yes.
retirement planning.
Yes.
It's where, how are we going to protect ourselves from future higher tax rates that are likely to come out? Congressional Budget Office just did a new revised report that says in 2035, our nation's debt is expected to be $52 trillion. The senior Social Security benefits, you might not know this. We've been hearing that in 2032, if Social Security Trust Fund will be insolvent, and that will result in everyone having to take a 22% pay cut to keep those benefits. That has now been revised to 24% pay cut. So they have to shore up that Social Security Trust Fund. Oh, I see that. Okay, somebody asked if we'll be able to get a copy of these presentation deck. I think we got to make sure if compliance lets us give them out, we will send them out. So we just have to check.
I think we're gonna try and post this, right?
Oh, yes, we're going to put this on our website. Okay, revisiting the prior question, in a Roth IRA, are capital gains realized and withdrawal from the Roth IRA included in the calculation of provisional income? No, they are not. If it's got Roth in front of it, you are protected. It is not part of the provisional income calculation. It has no impact on your Social Security benefits. If it's Roth, it's now protected from any future higher tax rates.
And that includes, just by the way, not only is it income tax free for you when you take withdrawals, it's also income tax free to your beneficiaries when you pass away and they inherit it. So it's a pretty nice deal, not only for you, but if there's any money left in there from an income tax standpoint, it's income tax free to your beneficiaries.
Yep, I love that comment. Hooray for Roth. Right. That's what we want to do. So this is the time. This was a huge gift with the extension of these tax rates. It makes it a real opportunity to do significant Roth conversions. And if you are under 63, if you're 62 or below, you want to really pack as much money in there because it's not going to affect your Medicare supplements either. So,
right. Real quick, because
yeah,
I know there's one question that probably somebody's thinking and it's just not asking, because I hear this a lot. So can you no matter how much income you have coming in, can you still convert? And the answer is yes. Conversion has nothing to do with how much income you have. Contribution to a Roth IRA has limitations based off of your income, but we're not putting money in from a contribution standpoint. We're converting what we have into a Roth. And so I can make $2 million a year in income, wages, and I can still convert whatever I want to. There's no limitation on that. I just can't contribute to a Roth IRA. So keep that in mind too as well. If you're thinking, oh, well, that sounds great, but I can't do it because my income is too high. No, you can from a conversion standpoint.
All right, we got a few more questions here. I got to just make these a little bit bigger so that I can see the questions. Okay, hold on, folks. Could the person, okay, hold on. I just saw them
Can you
here.
convert interest on an annuity into Roth, and how much can you convert at 62?
Yeah, I can go ahead and take that. So first of all, if it's interest that you're receiving from an annuity, then no. If it's an annuity itself, that's IRA that you are that and it's a traditional IRA annuity, depending on the type of annuity, you can convert part of that or so that's called a partial Roth conversion with an annuity. Some annuities do not allow for partial Roth conversions. So if you have $100,000 annuity that does not permit partial Roth conversions, you can convert it, but you'd have to convert the whole $100,000.
Mm-hmm.
And there's no age limit on conversions. You do not even have to be 59 and a half to do a conversion. You just have to have money available to pay the taxes.
Uncle Sam wants his tax dollars.
Got it. Caprice,
Another
we got more
question.
questions.
Could these provisions accelerate the Social Security defunding timeline of 2032 to any time earlier?
That's interesting. Oh, well, I was going to say I just read it, and I'll give my 2 cents. Hamilton, please take over. But it didn't change the time frame. But what I read recently is it changed the percentage of potential deduction in benefits.
Yeah.
So it went from a 22 to 24 because of those changes.
Right. Long story short, they've got to do something. Whether they did this, no taxes on Social Security or whatever, they did or did not, it's irrelevant from the standpoint of something's got to give as it relates to Social Security, because the problem is you have more people retiring, i.e. baby boomers, than you have coming into the workforce paying into Social Security. And that's the problem that we have right now. And so they've got to figure out how to shore that up. And there are some things that they can do. They just, look, folks, we're dealing with Congress here. It's not a presidential issue. It's a congressional issue. The House and the Senate have to figure out how to come together and decide what's going to be the best. And nobody wants to do it because it's called political suicide. They want to get reelected. And if you're going to get reelected, you don't want to touch Social Security. But sooner or later, they're going to have to do something. And I predict in the next probably 2 to 4 years, there's going to be some significant changes in how Social Security is going to be done to try to shore that up.
All right, Caprice, any other questions?
One last question. Can any type of money asset be converted to Roth?
So any kind of tax-deferred retirement account can be, so that could be a 401k, a 403b, a simple IRA, a SEP IRA. It has to be in a tax-deferred account. So money in your checking and savings accounts cannot. Any other questions?
Nope. I guess if anybody wants to have a question, I guess they can email.
Yeah. Well, that concludes our webinar. Let us know what you thought about this webinar, whether you found value in it. As topics come available that we think it's important for you to know about, or just to bring added education, we will be doing more of these webinars in the future. So getting any feedback would be greatly appreciated. Thank you so much, Hamilton, for enlightening us on the big, beautiful bill and taxation. And we appreciate your time. Thank you, everyone,
Welcome.
for joining us.